Welcome to Talk Tickers. So we often think of precision instrument manufacturing as this completely sterile, perfectly controlled environment, right?
Oh, absolutely, like a hermetically sealed laboratory.
Yeah, exactly. You picture this lab where a standard weight is placed on a digital scale, and the readout just flashes a number down to the exact microgram. It's binary, it's exact, and it's completely isolated from the outside world. And we naturally expect the companies that build these instruments to operate with that same level of, unbroken clarity.
We do. And honestly, it's a super common cognitive bias in investing. We look at a company whose entire brand is built on scientific accuracy, and we project that accuracy right onto their financial statements. We want the metrics to be perfectly clean. We want the revenue categories cleanly defined, and we want the forward-looking guidance to plot neatly onto this perfect linear graph.
But the reality of global macroeconomics in early 2026 is, it's anything but a sterile laboratory. We're looking at a manufacturing and financial landscape where that highly sensitive scale is basically sitting on a table that is constantly vibrating.
That's a great way to put it.
Thanks. You have geopolitical conflicts disrupting supply chains, shifting trade policies, rewriting cost structures overnight, and divergent economic recoveries across different continents. So reading a company's true operational value through that level of external vibration requires peeling back several layers of accounting and really looking at the raw mechanics of the business.
It requires looking past the aggregate data, for sure. When a multinational corporation reports its earnings, the headline numbers are essentially a blended average. They're an average of dozens of different regional economies, product lines, and currency fluctuations. The real analytical work involves isolating the signal from all that noise.
And that's exactly what we do here. Welcome to this deep dive. Today we're breaking down the Q1 2026 earnings call for Mettler-Toledo International Inc., ticker symbol MTD. This is a company that provides a crucial window into the global economy, which is why we are translating this Wall Street jargon into actionable insights for your portfolio.
Right. MTD designs and manufactures precision instruments used in laboratory research, industrial manufacturing, and food retail packaging. And because their equipment is deeply embedded in the supply chains of pharmaceutical companies, chemical plants, and logistics hubs worldwide, their quarterly performance serves as a highly accurate macroeconomic barometer.
Yeah, if capital expenditures for research and development are tightening up in academic institutions, Mettler-Toledo sees it right away in their pipette sales.
Exactly. And if chemical manufacturing slows down in Europe due to energy costs, they see it in their process analytics division. And conversely, if there is a surge in advanced manufacturing and automation in Asia, they are uniquely positioned to capture that infrastructure spending. Their earnings call is essentially a diagnostic report on the health of global industry.
So to understand the specific trajectory of MTD's stock and what it implies for the broader market, we have to start by dissecting the raw tape they just reported. Let's look at the headline numbers from the first quarter. Mettler-Toledo reported total sales of $947 million.
Okay.
In reported U.S. dollars, that looks like a 7% jump year over year. However, in local currency terms, the sales increase was only 3%. On the bottom line, their adjusted earnings per share, or EPS, came in at $8.91. That represents a 9% year-over-year increase, beating management's own internal guidance by 13 cents.
Okay, so the spread between that 3% local currency growth and the 7% reported U.S. dollar growth, that requires immediate translation.
Yeah, let's break that down.
For a multinational entity, foreign exchange rates function as a mechanical filter over their actual performance. Mettler-Toledo generates revenue across the globe, in euros, Swiss francs, Chinese yuan, Japanese yen. When they close their quarterly books, accounting standards require them to translate all of that international revenue back into their reporting currency, which is the US dollar.
Let's walk through the actual mechanics of that translation so it's perfectly clear for you listening. Imagine MTD sells a highly calibrated industrial scale to a factory in Germany for 10,000 euros.
Right.
If last year the exchange rate was €1 to $1, they would report $10,000 in revenue. But if the euro strengthens over the next 12 months and the exchange rate moves to, say, $1.1 per euro, that exact same 10,000 euro sale now translates to $11,000 on their income statement.
Exactly. The company didn't sell more scales. They didn't raise the price in Germany. The operational volume remained completely flat, but the reported US dollar revenue grew by 10% purely because of the currency fluctuation. Yeah. And this is why management noted that foreign exchange provided roughly a 2% benefit to their overall sales growth this quarter. To evaluate the true health of the business operations, we have to strip away the currency translation and look exclusively at the 3% local currency growth. That 3% tells us the actual volume of goods moving out the door and the pricing power they wield in their local markets.
Makes sense. Now, the bottom line, EPS growth of 9% is structurally solid, especially given the macro environment. However, there is a specific metric in this report that could easily trigger a sell-off if an investor doesn't understand the underlying accounting mechanics.
Oh, the gross margin.
Yeah, the gross margin. The summary states that MTD's gross margin dropped 80 basis points, coming in at 58.7%. And just a quick reminder, a basis point is 1/100%, meaning gross margin compressed by 0.8%.
Right. And for a company trading at a premium valuation based on its intellectual property and precision engineering, margin compression is typically viewed as a severe structural warning.
Definitely a red flag for retail investors scanning the headlines.
Oh, massive red flag. It usually implies one of two things. Either the company is being forced to discount its products to maintain sales volume, which indicates a loss of pricing power, or their internal manufacturing costs. Labor, raw materials, freight are rising faster than they can adjust their prices.
So if you see that 80 basis point drop in isolation, the immediate assumption is that the core business is deteriorating. But this is a classic optical illusion caused by the mechanics of corporate accounting. I look at this margin drop like looking through a windshield that has just been hit by a localized splash of mud. The view ahead looks terrible, but the weather itself hasn't changed. The glass is just temporarily distorted.
I like that analogy.
Thanks. We need to explain exactly how foreign exchange rates and recent corporate acquisitions create that accounting distortion.
Yeah, we can start with the acquisitions. When Mettler-Toledo acquires a smaller technology company, they integrate that company's revenue and inventory into their own financial statements. Under standard accounting rules, the acquiring company often has to write up the value of the acquired inventory to its fair market value.
Right.
When that specific inventory is eventually sold, the recorded cost of goods sold is artificially higher than it would be under normal operating conditions. This creates a temporary, mathematically unavoidable drag on the blended gross margin.
Okay. That makes sense. Additionally, the foreign exchange dynamic we discussed earlier applies differently to costs than it does to revenue, depending on where the manufacturing takes place. If you are producing components in a country where the currency is strengthening against the dollar, your manufacturing costs rise in dollar terms, compressing the margin on paper even if the localized profitability remains unchanged.
Exactly. So when management stripped out the unfavorable foreign currency impacts and the dilutive accounting effects of their recent acquisitions, the underlying operational gross margin did not contract at all. It actually expanded by 10 basis points.
Wait, really? It expanded?
Yeah, it expanded. The core business became slightly more profitable on a gross basis.
But getting to that 10 basis point expansion required overcoming a pretty significant structural hurdle. The transcript reveals that MTD faced a 90 basis point gross headwind, specifically from incremental import tariffs. Management detailed that the gross impact of these incremental tariffs reduced their overall operating profit by roughly 4%.
Yeah, and to understand the mechanics of that 4% hit, we have to look at how tariffs interact with the global supply chain. Import tariffs are essentially taxes levied by a domestic government on goods manufactured in a foreign country. Mettler-Toledo utilizes a global manufacturing footprint. If they manufacture specialized electronic components in Asia and then import those components into the United States for final assembly and calibration, they are required to pay a percentage of the component's value directly to the U.S. government at the border.
So this directly increases the cost of goods sold. If an internal sensor costs $100 to produce in an Asian facility, and the U.S. government levies a 25% tariff on that specific class of electronics, the cost basis for MTD suddenly jumps to $125 the moment it crosses the ocean.
Right.
That $25 difference comes directly out of their operating profit. To absorb a 90 basis point tariff headwind and still expand underlying margins by 10 basis points, the company had to generate a full 100 basis points of efficiency or revenue growth elsewhere just to mathematically break even on the margin side.
And they achieved that mathematical offset primarily through highly disciplined pricing power. Management confirmed they realized a 3.5% price increase across their global portfolio in the first quarter.
Implementing a 3.5% price increase in a business-to-business industrial environment is vastly different from, like, a consumer brand raising the price of a streaming subscription.
Oh, completely.
These are negotiated, often multi-year contracts involving massive capital outlays. We need to examine how Mettler-Toledo actually forces that price increase through without losing the customer to a cheaper competitor.
It really comes down to the switching costs and the demonstrable return on investment, or ROI, of the equipment. MTD is not selling commoditized steel or basic office supplies. They are selling integrated workflows. A pharmaceutical customer isn't just buying a scale, they are buying a connected system that automatically logs weight data into their compliance software, ensuring they meet stringent regulatory requirements.
So if that pharmaceutical company decides to reject the 3.5% price increase and switch to a cheaper competitor, they don't just swap out the hardware. They have to rewrite their standard operating procedures, retrain their entire laboratory staff on a new interface, revalidate the new equipment with regulatory bodies, and risk potential downtime during the transition.
Exactly.
The internal cost of switching is astronomically higher than simply absorbing the 3.5% price hike.
Furthermore, MTD justifies the price increase by demonstrating how their equipment reduces the customer's operational expenditures. If a new automated sensor costs 3.5% more, but saves a laboratory technician 2 hours of manual data entry per shift, the equipment pays for the price increase within a matter of months through labor savings alone. This structural pricing power is what isolates MTD from standard inflationary pressures and supply chain taxes.
Okay, so that covers the aggregate mechanics of the first quarter. The top line is expanding, the bottom line is beating estimates, and the underlying margins demonstrate real pricing resilience. But aggregate data, as we noted earlier, is just the average of the entire class. By looking deeper into the regional data, we see a clear divergence in performance across different global sectors.
Yeah, a real tug of war.
Right. Let's examine the specific market drivers, starting with the regions that are actively pulling the aggregate numbers higher.
The most prominent positive signal from this earnings call originated in China. Over the past several quarters, the Chinese market has been a significant drag for many global industrial manufacturers, characterized by sluggish demand and a complex economic reset. However, Mettler-Toledo reported 4% overall local currency growth in China for Q1.
While 4% overall growth is steady, the underlying composition of that growth is what stands out. Their laboratory business in China experienced slight contractions, but their industrial segment surged into the high single digits. Management confirmed this is the third consecutive quarter of robust growth in the Chinese industrial sector, indicating a sustained trend rather than a single quarter anomaly.
And the driver behind this industrial surge is rooted in a fundamental shift in Chinese manufacturing. Historically, Chinese manufacturing advantage was heavily reliant on abundant, inexpensive labor. As their demographics shift and labor costs rise, the industrial base is being forced to transition toward advanced automation and digitalization. The CEO, Patrick Kaltenbach, specifically highlighted that the growth is not coming from basic, standalone weighing scales. It is being driven by core automation systems.
These systems integrate directly into the nervous system of the manufacturing line. MTD is supplying the sensors, the continuous monitoring analytics, and the automated feedback loops that allow a factory to run with minimal human intervention.
They are particularly dominant in what they classify as hot segments. For example, they noted intense momentum in battery manufacturing. As China scales up its electric vehicle infrastructure, the production of lithium-ion batteries requires microscopic precision in the chemical formulation and quality control stages.
Right, because any deviation in the chemical mix can result in a defective or dangerous battery cell.
Exactly. MTD's continuous process analytics tools are critical for that high-volume, high-precision environment.
They also highlighted their ultra-pure water business within the semiconductor space. Manufacturing a silicon wafer requires water that is stripped of almost all natural minerals and contaminants. MTD provides the analytical sensors that constantly monitor that water purity. Even though it is a lower single-digit contributor to their total revenue, the growth rate in this highly specialized niche is accelerating as China aggressively expands its domestic semiconductor capacity.
To anchor themselves in this local expansion, MTD is executing a strategy they refer to as China for China. This involves localizing their research, development, and manufacturing to serve the domestic market directly, bypassing international supply chain risks. During the call, management mentioned securing a $6 million grant from the local Chinese government to support this initiative.
The mechanics of localized government grants are critical to understand. The Chinese government, often at the provincial or municipal level, provides targeted financial incentives to foreign technology companies willing to build advanced infrastructure within their borders. These aren't just blank checks. They are structured offsets against capital expenditures, such as building a new facility, or tax credits applied directly against local research and development payroll. By accepting these grants, MTD lowers its internal cost of capital while simultaneously aligning itself with China's broader industrial policy goals, deeply embedding their technology into the domestic ecosystem.
That's right. And parallel to the strength in China, their global product inspection division posted blistering growth, expanding by 11% in local currency.
Okay, 11% is massive. Product inspection equipment includes industrial metal detectors, X-ray machines, and dynamic checkweighers positioned at the end of manufacturing lines. To understand why this division is growing at 11%, we have to look at the physics and the economics of a modern food or pharmaceutical production line.
When a factory is producing thousands of packaged goods per hour, they cannot manually weigh or inspect every single item. A dynamic checkweigher is integrated into the conveyor belt, weighing every single package as it moves at high speed. If a box of cereal is under the stated weight, it violates consumer protection laws. If it is over the stated weight, the manufacturer is giving away raw materials for free, destroying their profit margin.
Oh, yeah.
The machine automatically rejects any package outside the precise tolerance zone without stopping the line.
And the X-ray and metal detection systems operate on a similar principle for safety. They identify foreign contaminants, a stray piece of metal from a broken machine part or a fragment of glass, and automatically eject the contaminated product.
MTD has aggressively targeted mid-market manufacturers with new, accessible product portfolios, expanding their customer base beyond just the massive global conglomerates.
Crucially, this equipment carries an exceptionally high service attach rate.
What does that mean exactly?
Well, a manufacturer cannot legally or economically operate their line if the end-of-line inspection machine is offline. If the X-ray machine breaks, the entire factory floor halts production. Because the cost of downtime is so astronomical, customers immediately purchase premium, recurring service contracts to ensure immediate maintenance and minimal disruption. This creates a highly predictable, high-margin revenue stream for MTD long after the initial equipment sale is recorded. Okay, so the data out of China and the product inspection division provides a really strong foundation. However, to maintain an objective analysis, let's play devil's advocate here. We need to examine the specific weaknesses detailed in the transcript. There are 3 distinct areas of contraction that require scrutiny. First, their laboratory division saw a decline in pipette sales, which management attributed to soft demand and funding delays from academic and biotech customers.
Right.
Second, core industrial sales in the Americas flatlined, citing customer delays stemming from broader market uncertainty. Finally, management explicitly called out the European chemical sector as a significant area of softness.
The contraction in the European chemical sector is the most complex macro issue on the board, and management explicitly linked it to the ongoing conflict in the Middle East. To understand this linkage, we have to look at the energy intensity of chemical manufacturing.
Yeah, because the entire process of chemical synthesis breaking down molecular bonds to create fertilizers, plastics, or industrial solvents requires massive amounts of continuous heat and pressure. And the primary input for generating that heat, and often the primary raw feedstock for the chemicals themselves, is natural gas.
Historically, Europe relied heavily on pipeline natural gas from Russia. When that supply was disrupted, Europe was forced to pivot to importing liquefied natural gas, or LNG, via ships. The geopolitical conflict in the Middle East has created severe disruptions in global shipping lanes, forcing LNG carriers to take longer, more expensive routes, which directly spikes the spot price of natural gas in Europe.
So as utility costs soar, European chemical plants see their operating margins just evaporate. In response, they immediately freeze all discretionary capital expenditures. They delay upgrading their process analytics equipment or replacing their weighing terminals because every available euro is being diverted to cover the cost of keeping the lights on. So if European chemicals are struggling due to Middle East war-driven energy spikes, isn't that a massive structural red flag for MTD's industrial base?
It's a great question, and it presents a critical challenge for our analysis. If MTD's legacy industrial base in Europe is structurally impaired by energy costs, and their America's industrial base is pausing orders due to general uncertainty, how does the company mathematically project overall growth?
Right, how do they offset that?
The answer lies in MTD's strategic pivot. They are actively substituting that legacy demand with revenue from highly capitalized emerging sectors. They are pivoting away from the traditional industry struggling with energy costs and deeply integrating themselves into the industries currently flush with capital, specifically bioprocessing, semiconductors, and domestic automated manufacturing.
The product launches highlighted in this earnings call are physical manifestations of this strategic pivot. Management spent significant time discussing the EasyMex Advanced Automated Lab Reactor.
To understand the EasyMex, you have to understand the bottleneck in chemical and pharmaceutical research. A scientist trying to scale up a new chemical compound doesn't just mix two liquids together in a beaker. They have to carefully control the temperature, precisely time the dosage of reagents, and constantly measure the stirring speed over hours or days.
And historically, this required a human technician to physically monitor the experiment, manually recording data points and making micro adjustments.
Exactly. The EasyMex completely automates that entire process. It is a closed-loop system equipped with smart digital sensors that continuously capture unattended data. A researcher programs the specific parameters, and the machine executes the experiment flawlessly, capturing thousands of data points per minute. Furthermore, the EasyMex includes an embedded vision system.
Wait, a vision system? Like a camera?
Yeah, a highly calibrated camera that continuously records the reaction, visually documenting changes in color, viscosity, or crystallization in real time.
Wow, so a scientist can set up a complex multi-day experiment on a Friday afternoon, walk away, and return on Monday morning to a perfectly executed reaction and a comprehensive digital data set. They also highlighted the launch of the PX1 autosampler, which fully automates the measurement of density, refractive index, and UV VIS parameters.
And by eliminating manual sample handling, the PX1 achieves several critical outcomes for a laboratory. First, it eliminates the variability of human error. A machine injects a sample with the exact same pressure and volume every single time, ensuring reproducible data. Second, it accelerates the measurement cycle, allowing a lab to process significantly more samples per shift. Third, and honestly most importantly from a liability perspective, it minimizes human contact with potentially toxic or volatile chemical compounds.
So when you look at these products, the value proposition shifts entirely. A struggling chemical plant in Europe might delay the purchase of a standard weighing terminal. However, a major pharmaceutical company building a new manufacturing facility is not going to hesitate to outfit their entire operation with EasyMex reactors and PX1 autosamplers.
And this demand is heavily insulated by the macro trend of reshoring. Over the past few years, global corporations have realized that sprawling, hyper-extended supply chains are incredibly vulnerable to geopolitical shocks. We are seeing a massive structural shift where companies are repatriating their manufacturing capabilities back to their domestic markets, a process requiring massive capital expenditures, or CapEx.
CapEx represents the funds a company uses to acquire, upgrade, and maintain physical assets like property, industrial buildings, or equipment. When a pharmaceutical giant decides to build a new, multi-billion-dollar facility in the Midwestern United States to ensure a secure supply of critical medications, they are deploying CapEx.
However, because labor costs in the United States or Western Europe are significantly higher than in the regions they are leaving, these new reshored facilities must be designed from the ground up to be hyper-automated. They require continuous inline monitoring and closed-loop data systems to operate profitably. The CEO noted that 50% of MTD's business is directly tied to manufacturing and another 20% to quality assurance and quality control. As this wave of domestic CapEx deployment begins to break, MTD is perfectly positioned to provide the essential digital infrastructure.
This dynamic is particularly evident in the biopharma sector, specifically regarding the build-out of capacity for GLP-1 drugs. GLP-1 stands for glucagon-like peptide-1 agonists. This is a class of medications initially developed for managing type 2 diabetes that has seen exponential demand explosion for weight management.
Manufacturing a biological drug like a GLP-1 is vastly different from synthesizing a basic chemical pill like aspirin. Biological drugs are essentially grown using living cells in highly controlled bioreactors. The environment must remain absolutely sterile. Even a microscopic level of foreign contamination can ruin an entire batch, costing millions of dollars and causing severe supply shortages.
Because the risk of contamination is so severe, biopharma manufacturers are eliminating human interaction from the production line entirely. Every stage of the process, from weighing the initial cell cultures to inspecting the final filled syringe, is handled by automated, sterile equipment. MTD's precision scales, automated liquid handling systems, and X-ray inspection tools are non-negotiable requirements for these facilities.
Yep.
The weakness in traditional academia and legacy chemicals is being heavily diluted by their deep integration into these high-margin, mission-critical growth sectors.
Right. So having analyzed the historical data of the first quarter and the structural shifts in their product demand, we must transition to analyzing the forward-looking models. Backward-looking data is great, but the stock market is a forward-looking weighing machine. The equity markets do not price a stock based on the revenue generated yesterday. They price the stock based on the cash flow expected tomorrow. We need to examine what MTD's management is specifically projecting for the remainder of 2026.
Yeah, let's get into the guidance. The guidance provided in the transcript reveals a bifurcated outlook between the immediate short term and the full year. For the upcoming second quarter, Q2 of 2026, management is issuing relatively conservative projections. They anticipate local currency sales to grow by roughly 3% and project adjusted EPS to land between $10.70 and $10.85. This represents a year-over-year EPS growth rate of approximately 6 to 8%, which is a noticeable deceleration from the 9% growth they just achieved in Q1.
And the CFO, Sean Vidala, explicitly outlined the rationale for this cautious Q2 posture. The structural headwinds we identified, the sluggishness in the European chemical sector, and the hesitant capital expenditure in the Americas industrial market are complex macroeconomic issues that will take time to resolve. Management is acknowledging that these pressures will continue to drag on performance through the spring.
Furthermore, they identified a specific vulnerability in their Americas retail division. MTD provides the scales and labeling equipment used in supermarket delis and checkout counters. Retail capital spending is notoriously cyclical and lumpy. Supermarket chains tend to upgrade their equipment in massive, infrequent waves rather than steady, predictable increments.
Exactly.
Management warned that the retail division faces very difficult year-over-year comparisons in Q2, meaning last year's numbers were artificially high due to a major upgrade cycle, making this year's numbers look worse by comparison.
However, the conservative Q2 guidance serves as a stark contrast to their full-year projections. Despite forecasting a muted second quarter, management actually raised their EPS guidance for the full year of 2026.
This is the most crucial data point in the forward-looking models. Previously, management had guided for an 8 to 9% EPS growth rate for the year. During this call, they officially bumped that target up, projecting full-year adjusted EPS to land in the range of $46.30 to $46.95, representing an 8 to 10% growth rate.
The mathematical implication of this raised guidance is significant. If you are officially telling Wall Street that the second quarter is going to be slow, yet you are simultaneously raising the target for the entire year, you are mathematically locking yourself into a scenario that requires a massive, aggressive acceleration of revenue and profit in the third and fourth quarters.
Management is explicitly modeling a second-half surge to offset the sluggish first half. Before we examine the fundamental drivers they believe will cause this surge, we need to analyze how they are deploying their capital, because it provides a quantitative measure of their internal confidence. Let's look at the free cash flow projections.
Free cash flow is the fundamental metric of corporate health. It is calculated by taking the total operating cash flow generated by the business and subtracting all capital expenditures required to maintain or expand the asset base. It represents the actual unencumbered cash the company has generated that can be used to pay dividends, pay down debt, acquire competitors, or return capital to shareholders.
Mettler-Toledo management stated they expect to generate approximately $900 million in free cash flow for the full year of 2026. And from that $900 million pool, they have officially authorized and plan to spend between $825 million and $875 million exclusively on share repurchases.
Yeah, and committing nearly 100% of your generated free cash flow to buy back your own stock on the open market is a definitive signal. When a management team evaluates all potential avenues for capital allocation, whether that involves buying a new subsidiary, building new factories, or issuing a cash dividend, and concludes that purchasing their own equity yields the highest internal rate of return, they are signaling a firm belief that the current market price severely undervalues the future cash-generating potential of the business.
We need to explain the exact mathematical mechanics of how a share repurchase program structurally benefits you, the retail investor holding the stock. Imagine a hypothetical company that has 100 shares of stock outstanding in the public market. This company earns $1,000 in net income for the year. To calculate the earnings per share, you divide the $1,000 by the 100 shares, resulting in an EPS of $10 per share.
Right. Now, assume the company uses its free cash flow to buy back 20 of those shares on the open market and retires them. There are now only 80 shares outstanding. If the company earns that exact same $1,000 in net income the following year, the math changes. You divide the $1,000 by the remaining 80 shares. The earnings per share suddenly jumps to $12.50.
The company didn't have to sell a single additional product, and their operational margins didn't have to improve by a single basis point. Yet the value of the earnings assigned to every remaining shareholder increased by 25%, purely through financial engineering. This buyback program provides a massive structural floor under MTD's stock price. If macroeconomic fears cause institutional investors to sell off shares, MTD's management is sitting at the bottom of the market with nearly $900 million in cash, ready to absorb that selling pressure and permanently retire the discounted equity.
Understanding that structural support, we can now evaluate the specific macroeconomic and internal variables that give management the confidence to project that second-half acceleration. The CFO, Sean Vidala, cited the stabilization and gradual improvement of global purchasing managers' indexes, or PMIs.
A PMI is a vital macroeconomic indicator. It is derived from monthly surveys into senior purchasing executives across thousands of manufacturing and service companies. The survey asks these managers if they are increasing or decreasing their orders for raw materials, inventory, and capital equipment compared to the previous month. The data is aggregated into a single index number.
The threshold for a PMI is 50. If the index reads above 50, it indicates that the manufacturing sector is actively expanding. If it reads below 50, it indicates contraction. PMIs are considered leading indicators because purchasing managers must order raw materials and equipment months before actual production and sales occur.
Oh, that makes sense.
Yeah, so when management notes that global PMIs are beginning to stabilize and trend upward, they are observing the early mathematical signals that global factories are gearing up for a broader cycle of expansion and equipment upgrades in the latter half of the year.
Beyond the external macroeconomic data, management is primarily relying on their internal sales pipeline architecture. In an enterprise B2B environment, a sale does not happen instantaneously. It follows a prolonged funnel. It begins with an initial information. Request for information from a customer, progresses through technical evaluations and proof of concept demonstrations, enters budget approval phases, and finally results in booked revenue.
And Vidala detailed that MTD is tracking a significant increase in activity at the very top of that sales funnel. The initial inquiries and technical consultations are swelling, particularly within the automated biopharma sectors and the localized Chinese manufacturing base. Because they possess years of historical data regarding how long it takes a prospect to move through the funnel and what percentage ultimately convert to a final sale, they can mathematically project that the current surge in early-stage pipeline activity will materialize as booked revenue on their income statement during the third and fourth quarters.
However, there is a highly specific variable embedded within this full-year guidance that highlights the management team's aggressive posture on pricing. The transcript reveals an assumption regarding the future state of U.S. import tariffs.
Right. In the first quarter, MTD actually received a slight temporary benefit due to an administrative pause in certain tariff implementations. However, management explicitly stated that their raised full-year EPS guidance assumes that in the second half of the year, U.S. import tariffs will revert to their historical higher levels under the IEPA framework.
Let's define that framework for clarity. In this specific regulatory context, the IEPA, or Import Enforcement and Protection Act framework, refers to the governing policies and duty rates applied to specialized industrial and electronic equipment imported into the United States. Management is building their financial models under the strict assumption that these governmental taxes on their supply chain are going to increase in the latter half of the year.
They are also modeling for persistent, elevated inflationary costs stemming from global freight disruptions linked to the Middle East conflict. The critical insight here is that management is forecasting an acceleration in total earnings despite intentionally modeling for an increase in supply chain taxation and freight costs.
When pressed by analysts on how they intend to achieve this math, the CFO stated that if inflation and tariffs remain elevated, they will initiate additional pricing actions. They are explicitly telling the market that their products are so deeply integrated into customer workflows that they will simply pass the entirety of the returning tariff and inflation burden directly onto the end user through further price hikes without fear of demand destruction.
It is a remarkable display of operational confidence. In an industrial sector where many executive teams are using geopolitical uncertainty and supply chain complexity as a shield to lower expectations and slash forward guidance, MTD is modeling for those exact same headwinds, raising prices to offset them, and increasing their total earnings target while deploying virtually all their cash to buy back equity.
Having thoroughly analyzed the historical data, the underlying operational mechanics, the strategic shifts in product demand, and the structural assumptions embedded in the forward guidance, it is time to synthesize this data. With all the data on the table, the earnings beat, the shifting global segments, and the raised guidance, it is time to give you a definitive verdict. So, bottom line, bullish or bearish signal?
Based on the preponderance of the data, the structural resilience of their margins, and the aggressive posture of their capital allocation, the verdict on this transcript is definitively bullish.
To articulate the foundation of that bullish verdict, we must evaluate the performance relative to the external friction the company endured. Over the past 90 days, MTD operated against a severe convergence of negative macroeconomic variables.
They absorbed the impact of a European industrial sector paralyzed by structural energy costs. They navigated a complex domestic environment where American manufacturing capital expenditures were delayed due to broad economic uncertainty. They faced funding freezes in academic research affecting their core laboratory division, and they actively managed a 90 basis point structural tax applied to their supply chain via import tariffs.
A legacy industrial manufacturer operating under those conditions would mathematically be expected to experience severe margin contraction, missed revenue targets, and a downward revision of future guidance, typically accompanied by management blaming the macroeconomic environment.
Instead, MTD absorbed the entirety of that friction, executed a 3.5% global price increase with minimal customer attrition, delivered a 9% expansion in bottom-line earnings, generated enough excess capital to fund a $900 million share repurchase program, and raised their aggregate projections for the full fiscal year.
The core thesis driving this performance is their successful transition from a provider of discretionary laboratory hardware to an essential architect of digitalized automated workflows. By pivoting their engineering focus toward inline process analytics, automated chemical synthesis like the EasyMex, and precision inspection tools for high-stakes biopharma manufacturing, they have isolated themselves from traditional industrial cyclicality. Their equipment is no longer viewed as a capital expense that can be delayed. It is viewed as an operational requirement to remain compliant and profitable in a modernized, reshored manufacturing environment.
For the retail investor analyzing this transcript, the actionable strategy requires balancing the long-term structural strength against the short-term anticipated volatility.
Yeah, so what does this mean for someone holding or considering the stock? If you currently hold MTD in your portfolio, the fundamental data strongly supports a hold position. The company is operating as an effective compounding vehicle. They are demonstrating the pricing power necessary to insulate your capital from inflation, and the management team is actively utilizing the generated cash flow to reduce the total share count, systematically increasing your proportional ownership of the company's future earnings without requiring additional investment on your part.
Conversely, if you are an investor looking to initiate a new position, the strategic approach involves closely monitoring the short-term friction management outlined for the second quarter.
The valuation of the stock already reflects a significant premium. Management has explicitly telegraphed that Q2 results will likely show a deceleration in growth, specifically pointing to difficult year-over-year comparisons in their Americas retail division and continued sluggishness in legacy industrial orders.
The modern equity market is heavily driven by automated algorithmic trading and institutional models that react aggressively to short-term headline misses. If MTD reports Q2 earnings that reflect the exact sluggishness management is currently warning us about, the algorithms may interpret the deceleration as a fundamental break in the growth story, triggering a short-term sell-off.
However, if you understand that the Q2 lumpiness is a temporary distortion, and you have analyzed the internal pipeline data and improving PMIs that point to a massive third and fourth quarter acceleration, that potential Q2 sell-off represents a highly strategic entry point. By waiting for the market to overreact to the short-term noise, you can acquire shares at a discount immediately prior to the projected second-half automation wave materializing on the income statement, maximizing the impact of the ongoing share repurchase program.
It requires patience and a strict adherence to the data, allowing the market's mechanical overreaction to serve your entry strategy.
As we conclude this deep dive, the transcript prompts a broader philosophical evaluation of how we construct investment models in the modern era. We dedicate significant time to isolating individual corporate variables, analyzing specific product launches, and calculating isolated margin impacts. But these earnings calls ultimately reveal the interconnected architecture of the global industrial base.
The concept of isolated risk is increasingly becoming an analytical fallacy.
This is perfectly illustrated by a specific contradiction embedded within the CFO's commentary. When outlining the risk parameters for their forward guidance, Sean Vidala explicitly reassured the analysts, stating, "We have an immaterial exposure directly to the Middle East." The intent was to calm investors by clarifying that MTD does not derive significant revenue from, nor do they possess critical manufacturing infrastructure within active geopolitical conflict zones.
It is a standard risk mitigation disclosure designed to project geographic safety.
Yet, within the exact same assessment, management detailed how the conflict in the Middle East disrupted global shipping lanes, which directly caused a spike in the cost of liquefied natural gas imported into Europe, which subsequently crushed the operating margins of the German chemical sector, resulting in those chemical companies freezing their equipment orders, thereby causing Mettler-Toledo to miss specific regional sales targets.
The contradiction is profound. The management team asserts geographic isolation from the conflict, yet the fundamental demand for their equipment is entirely dictated by the energy derivatives created by that exact same conflict. It challenges the listener to consider, in today's hyperconnected industrial landscape, is there really any such thing as a regionally isolated stock, or are all manufacturing portfolios ultimately just trading on global energy derivatives in disguise?
It really challenges the traditional concept of portfolio diversification. An investor may intentionally allocate capital to a Swiss-American precision instrument manufacturer with the belief that they are purchasing stability, entirely insulated from the volatility of global commodity markets or regional conflicts. However, in a hyper-optimized, hyper-connected industrial landscape, every single manufactured good, from a basic plastic polymer to a highly automated GLP-1 bioreactor, requires massive amounts of continuous energy to produce.
The fundamental insight is that when you strip away the corporate branding, the localized currency translations, and the proprietary software interfaces, virtually all industrial and manufacturing equities are ultimately trading as complex derivatives of global energy costs. If the cost of power fluctuates due to a geopolitical shock thousands of miles away, the shockwave inevitably travels through the supply chain until it compresses the capital expenditure budget of the end user, directly impacting the earnings of the precision instrument provider.
The digital scale can be calibrated to measure a single microgram, but it remains permanently tethered to the table it rests upon. When the macroeconomic fault lines shift, the entire table vibrates. The objective of our analysis is not to search for a fictional company that operates in a vacuum, completely immune to the vibration. The objective is to understand the physics of the underlying market, break down the mechanical strength of the company's balance sheet, and learn how to accurately read the true operational numbers through the chaos. Thank you for joining us for this deep dive. Keep looking past the headline Wall Street jargon, focus on the fundamental cash flows and pricing mechanics, and continue analyzing the data that dictates the true value of your portfolio. Until next time.